Hi, everyone. Welcome to this edition of Portfolio Partners Fireside Chat, where you meet your fund managers. Today we have Brandon Quinn, who, despite his youthful appearance, has been in the industry for 30 years plus. So he's had a few experiences, and you'll be hearing about what he's been doing recently with a portion of your income fund money in the Saffron Opportunity Fund. So, Brandon, welcome to the program.
Thank you, Jim, and thanks for the opportunity.
Absolutely. Brandon, would you like to start off by introducing us to your team at Saffron?
Sure. Yeah, Jim, we've been around since 2012. Prior to Saffron, we were at Metropolitan Asset Managers, and before that at a New York commodity trading company. So, I can keep going back and back, but over those 30 years, but I think 10 years is possibly long enough. We've been managing funds at Saffron since 2012. So our business, which is a hedge fund company, a Category 2A, has been running funds since 2012. And in fact, one of our funds had its 15-year anniversary, which is the Opportunity Income Fund this year. So the fund in which you invest is in fact 15 years old. It was started at Metropolitan, and we've continued that exact strategy since then. Let me share with you a little bit of
your team.
Of our team.
So, yeah, but just a question there, Brandon. Seeing as you've been in the industry for over 30 years, would you say that experience is something that you only get just after you need it?
I would tend to agree with that. Because everything is 50 or 2020 in hindsight.
Yeah.
And like I often mention to the younger team members, investing is two-dimensional, in fact, multi-dimensional. But the two important dimensions that I often talk about, the first is understanding markets, and there you can study. You can study mathematics, you can study quants, you can study statistics, you can study finance. The second, and those carry with it very important lessons and skills. The second important thing is understanding yourself and one's own reaction to market events. And I think that's a level of experience that you can only have through time, because you can't choose the market events that you face. But yeah.
Let's talk about the fund that we're in, which is your Saffron Opportunity Income Fund.
Yeah.
Okay, so over the last year, just talk us through the performance.
Through the performance over the last year. Well, it's been a very, very interesting year. We saw absolutely enormous returns coming out of long-dated bonds. Some of the long-dated bonds performed in excess of 20% on a year-on-year basis. Of course, it really goes to the core of what one's looking for in income space. Our fund is an income fund. We have very explicit parameters in terms of how much risk we can take, and that really results in the smooth return profile that we create in the fund. Some other income funds may have much higher duration and are probably more akin to a bond fund than an income fund. So our fund we would consider as more of a purist income fund, an actively managed income fund.
So basically, you're aiming to outperform the STEFI by 2%, roughly?
By 2%, correct.
Yeah.
And
which you've been doing.
Which we have been doing, and which we have been doing for the last 15 years.
Right.
Importantly here is that 2% over cash is a fairly ambitious benchmark. To outperform by 2% on a consistent basis requires a tremendous amount of work and focus. What we didn't want
to do. This is something that I think our viewers would be very interested in. People think, oh, it's a money market and it's an income fund. an extra 2%. I think you would know, you've done the numbers many times.
Mhm.
I think if you make an extra 2% a year for 20 years, it's an
Yeah.
enormous difference.
Absolutely. No, the compounding effect is enormous, especially if you manage to deliver that extra 2% with an acceptable level of volatility. You don't
Mm,
want to be making 4 the 1 year and -2 the next. So that gives you an average of 2 over 2 years.
mm,
We want to deliver a consistent 2 every year with a low level of volatility.
right. Well, that then would be interesting to see the longer term for your funds to illustrate what you've been saying here.
Sure.
Uh,
Here's our 5 year return. Over 5 years, you can see that we would have made almost 42%. And of course, bearing in
mhm,
mind this is after fees. So a clean 42%
mm,
on our most expensive fee class as well. This is at a fee class of 1%. Obviously, you guys have a much lower fee class because of your cunning negotiations. But um,
yeah,
ours is at 1%.
team
Our investors would have made
teamwork with our
42%.
clients. Yeah, yeah.
Yes,
So
absolutely.
basically, so in a sense, if they'd kept their money in the bank, they would have probably over the last 5 years made roughly 30%,
They
kind of,
would have made
more or
roughly
less.
30% if they had been 100% invested all the time,
Yeah.
and got the roles right. There's a lot of
Mm.
assumptions in achieving that
Even in that,
30%.
yeah,
Yeah,
probably would have been less.
it
Yeah.
probably would have
So
been less. Yeah,
so you're basically like 11% more than that over 5 years. So yeah.
Ab-
So that essentially is just over the 2% outperformance that you've been talking about.
exactly right. Exactly
Yeah.
right. And
Yeah.
importantly is that our investment proposition comes with daily liquidity. So,
Mm.
many of those cash or cash equivalent type instruments to achieve our kind of number, in fact, less than our number, would have required locking up one's cash for, 12, 24 months, even longer. And
Right.
certainly to extract the money from a long-term bank deposit, obviously carries with it penalty fees as well as,
Yeah.
uh, yeah,
Costs. Yeah.
costs.
So
Yeah,
yeah, no, you're not getting anything for free at the bank. That's for
that's for sure. Hmm.
yeah. So okay, maybe if you want to just go to the large screen now, we can. I wanted to ask you to explain something, very fundamental for clients.
Hmm.
People talk about income funds, money market funds, income funds, and bond funds. And from a layman's point of view, essentially,
Hmm.
what is the difference? What would you expect if you're in a money market, an income fund, or a bond fund?
Fund. Well, let's start with the money market fund. So money market funds, you would be happy with typically achieving what we call STEFI, the
Mm,
short-term fixed income index.
yeah,
And that STEFI index was the cash return that I showed in the previous slides. A money market fund typically invests in instruments that are less than 13 months. So they typically can't invest longer than 13 months.
yeah,
What that means is that in a declining interest rate environment, their returns obviously move lower with those declining prime lending rates, etc. Our investors would typically think of the prime lending rate as the applicable rate. We would think about the repo rate as the applicable rate. So as the repo
so
rate comes down, their returns
and
diminish.
the underlying instruments, or the underlying people who are paying the interest, is the
Mm.
banks, basically. Is that correct?
Absolutely. Yeah.
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 So if you're in a money market fund, you're only investing with banks,
Pretty,
essentially, or you're
pretty
depositing
much.
with banks.
Pretty
Yeah.
much banks, I'd say probably 80-90% banks, and
Yeah.
then some bonds that become short dated over time. So
Right.
a 5 year bond may have been issued 4 years ago, and now it's a 1 year instrument. It becomes
Short. Yeah.
available, but obviously now, because it's at the 1 year point, the yields are much lower. So I would say
Okay.
typically money market returns are materially lower than flexible income funds. You
Right.
certainly couldn't get a money market fund offering, north of 2% over time.
Right.
Yeah.
Okay. So then the income funds are in the middle,
In the
basically.
middle,
So,
absolutely, between bonds and money market. So
mm,
flexible and actively managed income is really the spot that we concentrate on.
mm,
What it means is that we, on behalf of our investors, we move the money across what we call the interest rate yield curve to try and optimize the highest level of interest for the lowest amount of risk. And
yeah.
that's what we do almost on a daily basis. We move money around on the yield curve between government debt, between bank debt, and between some specific corporate debt where we think we can extract a higher return for our investors.
Yeah. And then what do you expect if you're investing in a pure bond fund? What is the risk and the reward?
Yeah, well, the risk and reward of a bond fund versus a flexible income fund is completely different.
Mm,
If we think about a bond fund with what we call a 6-year, with a duration of 6 years, so we use duration as a measure of risk, and that just means for a 1% increase in interest rates or decrease in interest rates, the bond fund, an all-B tracker, as it were, would lose or make 6%. Our duration on our fund is sitting at about 1 to 1.5, means that we have 1.5% worth of risk embedded in the fund. That's without active management. So that's just assume you do nothing.
mm,
So the quantum of risk is polar. Um,
yeah.
and bond funds can make extraordinary money, extraordinary returns at specific points in the cycle. Um,
Mm,
if one compared our actively managed opportunity income fund with the all bond index, for example, over the long term, our opportunity income fund actually outperforms bonds. So you
yeah.
actually, over the long term, are getting a higher rate of return for lower levels of risk over the long
Yeah.
term.
So in every so often there's an opportunity where bonds outperform everything else, but then there's also the opposite when interest rates start going up or
Absolutely.
something else happens.
Or something else happens. Yes, an
Uh,
event, events such as Nanny Gate, for
yeah.
example, would have had a disproportionate effect on a bond fund compared to an income fund.
Yeah. Now I've heard you talking about this concept of running yield.
Mhm.
Would you like to explain that to our viewers,
Sure,
Brandon?
sure.
Yeah. You
Every
want to show
instrument,
that slide, perhaps?
yeah. Let's have a look at that.
Yeah, that's all this industry terminology is what our clients hear from us quite often, but they
Yes,
probably never quite get the clear what it is that
clear
you're
picture of what
saying.
it is.
Yeah,
Absolutely. So
yeah,
every fixed income, and that's the other term that's bandied around, fixed income, and fixed income can actually be floating or fixed, but
yeah.
we group it under the term fixed income or interest rate based instruments. So all
Mm,
interest rate based instruments have an embedded interest rate in them. And when we
mm,
talk about the running yield, we talk about achieving the interest rate that was prevailing at the time you purchased it of that instrument. And
mm,
assuming that there are no capital re-ratings, in the form of credit ratings or country re-ratings, that will be the yield that you achieve over the life of the instrument. To bear that in mind, it's over the life of the instrument. So if you
yeah.
had an 8% yield over 2 years, that means that you would make 8% per annum for 2 years. That said, if you exited it before then, it may not achieve that 8% for the period for which you hold it.
Mm.
So it's important. I suppose the most important thing is running yields or yields to maturity are very much a factor of holding an instrument to maturity.
Right. Now, just a very simple question. Maybe I hope it's simple.
Hmm.
your running yield in Saffron Opportunity Income is 9.2, but over the past
Correct.
year, you've achieved over 10%.
Yes.
Now, what explains that 80 bips, 80.8% difference?
Yes, that's where active management comes into it. That's where,
Okay.
because our goal is to buy instruments where at a good value level and sell them when other folks are demanding them. In other words,
Yeah.
sell them at a capital profit. So the difference between our running yield of 9.2 and our actual achieved total return is from active management.
Okay.
So
And then your bond fund, your active bond fund has a higher running yield, but it is a much longer duration, as you've mentioned earlier.
yeah, a
So
much
it's got
longer
more
term.
volatility in it.
Absolutely. Yeah.
Yeah.
Now, our active bond fund is sitting at 11.4% right now. And
Mm.
bearing in mind, these things change every single day, depending on the level of the market.
Mm.
You've been looking at our funds for a very long time, and you can see how our running yield reacts to market changes.
Mm.
I would say in the last month or so, though, the running yield on our active bond fund has moved from around about 12%, just north of 12% to 11.4%.
Yeah.
Now that's because the market has rallied. So our active bond fund has made rather large capital gains over the recent past through the process of converting running yield into capital gains. So 11.4 is still a good number, but like we said earlier, it comes with other risks, which is interest rate sensitivity.
Well, that's leads me into my next question, Brandon. Our Reserve Bank governor awarded us a nice, gigantic 1/4% cut
Yes.
last week? So what is the effect of interest rates going down on funds like this?
Yes. Well, the impact of a reduction in central bank rates is obviously
Yeah.
very different depending on which fund it is. So in the context of a bond fund, the impact is
Yeah.
larger. In the context of an income fund, it's smaller.
Mm.
In the context of
Right.
a money market fund, it's pretty negligible. But
Yeah.
reducing central bank rates will tend to lower the expected return of money market funds. And that's why we prefer the flexible space, because in the flexible space, we're able to increase our duration to an area where we think we're being appropriately compensated for the risk we're taking.
Right.
And as a result of that, you can see there on the screen, our running yield right now is sitting at 9.2%. But if you have a look at where cash rates are, they sub 8. So because of
Okay.
the
Right.
flexibility of
So
our
I
income
think.
fund, we're able to maintain that running yield higher, despite the fact that rates are actually coming down.
Mm.
Obviously, it does impact us, but not on a kind of one-to-one basis, as would be the case in a money market fund.
A big part of your job is looking at all those other things that are in between.
Absolutely, absolutely.
What what sort of other instruments do you look at in order to get an additional return on the funds?
Yeah. Well, to start with, I mean, the most basic choice is between a fixed and a floating instrument. So do
Okay.
you want to lock in a fixed yield over a specific amount of time, or do you want an instrument that pays you the prevailing interest rate plus a spread over time? So the decision of fixed and floating is an important decision. Our funds, we typically have a core of floating rate interest rate instruments, and then we blend it with fixed rate instruments. So that means that our fund sensitivity to interest rate movements is reduced. That's typically one of the primary choices of a fixed income fund manager. Another important choice is the extent to which you introduce corporate debt. And there, of course, the quality of the borrower is very important. I've got a slide here that can.
Yeah. So what sort of names are you talking about there when you say quality corporates?
Absolutely. Um, So if we look at the typical composition of our funds, we've got core assets, and they consist of cash, money market instruments, government bonds, and South African bank debt. And there the names are, the typical household names in South Africa: Standard Bank, Investec, Capitec, Absa, First Rand, etc. The red blocks are the local blocks. Being a flexible income fund, it means that we can effectively scour the globe for good fixed income instruments. And that includes other bank debt and other country debt. Of course, we don't take currency risk because we hedge it all back into ZAR. And that's why you see that smooth return profile, despite the fact that we are finding assets for you that outperform South African assets in other jurisdictions, like the UK, the European Union, and the US. So from an offshore perspective, we invest in the likes of Barclays, SocGen, and Standard Chartered. So we use large institutional banks in the offshore space to enhance our yields. The other thing that we look at is obviously corporate debt. And of course, we have stringent lending limits with regard to corporate debt, and effectively the principle of diversification. And there we would look at names like Bidvest, Growth Point, Discovery, Northern, Toyota, Netcare, as well as offshore Allianz and NatWest. So those are large insurance companies, as well as offshore banks, and we use that to enhance the yield that we can generate for our investors.
Yeah. So in your typical fund, you would have how many potential borrowers?
In our fund right now, we must have north of about 40 potential
There you go.
borrowers. Yeah.
Yeah. So it's very diversified, and
Yeah.
even if one of them does fail, it's not going to cause a major upset within the total return.
Absolutely.
Yeah.
Absolutely. Yeah. And of course,
Okay.
bearing in
Well,
mind that all issuers can fail, no matter, governments fail, corporates fail, all issuers can fail. As soon as you're lending money to another party, one runs the risk of failure. And in fact, when one's thinking about equities, even in the form of ordinary share capital, that's also lending money to a company or a corporation, with a risk of failure, just with higher volatility in the equity
yeah.
space versus in the fixed income space.
Well, fortunately, most of the names that you invest in have been around for a very long time. So it would seem to me they're pretty, strong businesses,
Pretty
and
strong
household
businesses, yeah.
names in most cases.
In most
Yeah.
cases, and of course we look in great detail into the balance sheets and the income statements of the companies. So our primary concern is repayability. Can the balance sheet sustain the debt and return us our capital? And that's where we spend a tremendous amount of time.
Okay. Right now, here's a real simple question for you, Brandon. Where are interest rates going to be at the end of this year?
Well, I'll
But
just whip out
let's
the
talk
crystal ball, but
about
yeah, well, that's what you pay us to do. You
yeah.
pay us to manage a view on where interest rates are going. Right now we're facing an environment of declining global growth. The IMF revised growth lower, so that's all positive for lower interest rates. Looking at the chart that I've attached to our presentation here, the red line is the South African central bank rate or repo rate, and the black line is the Federal Reserve, the Fed funds rate. At this point in time, our repo rate sitting at 7.25. The market, and we measure what the market expects through various measures that we get, that we can quantify. There are 2 rate cuts priced in over the next 12 months. So that'll take us down to 6.75%. In the US, that's going to decrease from 431 to about 375. Also 2 rate cuts. And importantly, with regard to our rates versus US rates, is you can see there's typically a spread or a gap between our domestic interest rates and the US. And that is the surplus or risk premium that an emerging market has to offer global investors to maintain their investments in our country. And as a consequence of that, to maintain a stable rand. So you
So
will
look,
see.
if am I right in by just looking at these numbers, it's usually somewhere around 3%
It's
additional
around
return
about 2.5, 3, sometimes a bit more percent.
to
Correct.
work even. Yeah.
Yeah.
So it would, if you look at these charts, you would think that our Reserve Bank is essentially following the Fed. Is that
That would be
correct?
what the evidence would suggest. Exactly right.
Yeah.
Yeah. Yeah.
Okay.
No, no, the
Yeah.
concept of central bank independence um, is somewhat opaque from the point of view that they can only do what their competitors or other sources of capital allow them to do. So as the Federal Reserve drops rates, it creates space for for emerging markets to reduce rates. If
Mm.
we maintain our rates too high, whilst the largest source of capital in the world, that being the US, is dropping rates, it will result in our currency appreciating to perhaps an unwanted extent, which means that our exports become less competitive. So there's always a balancing act between the strength or weakness of a currency and the interest rates that that the country offers.
Okay. Well, look, Brandon, we're going to have to wrap this up, but just a final opinion from you.
Hmm.
I have read somewhere that, and you've been in the industry for over 30 years, so you would know. I've read somewhere that about 82.7% of all statistics are made up on the spot. Would that sound correct?
Maybe 83%.
There you go. I knew you'd have it very accurately calculated. All
Yes.
right. Well, Brandon, I think our viewers will be very much more clear about what they're investing in and what an income fund is and what to expect. And so thank you very much.
Hmm.
That was a great, very easy to follow presentation. So
Excellent. Hmm.
everybody, thank you for watching this Portfolio Partners Fireside Chat. And we'll be back in a few weeks' time or a month's time with another one of these for you. So this is where you get to meet your fund managers. Thank you, and all the best until next time.
All the best. Thank you, Jim.